Today's episode of Market Talk is brought to you by GrowMark FS. Keeping up on the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. Well, Wednesday's trading session was a tale of how it looked at the start versus how it looked at the end, and it was totally different. We started off with a little bit more optimism than what we ended up the day with on Wednesday. A lot of things to look at, a lot of things to consider. Here to help us break it all down, we welcome in our good friend Mike Zuzolo, Global Commodity Analytics, joining us today. Mike, good to catch up with you again, sir. Hope your week's going well. This market, I said it before we jumped on, I thought we were going to have a positive day to talk about, and it just kind of just went down the tubes as we worked through the session, Mike.
Yeah, and you bring up a big piece of the puzzle here, Jesse, I think, because we needed some momentum and some sentiment indicators to kind of flip on us and turn more positive, especially in the aftermath of last week's USDA report showing a tighter supply and the way we came back after the MLK holiday with a continuation to the upside. And we had those tailwinds. Probably most importantly, we had those tailwinds in those outside markets. We made a new 5-month low in the US dollar today after the PPI and retail sales data came out, and we were able to get up above $82 in the WTI crude, a new monthly high. Those are two of the big features that we had been kind of under pressure due to the exact opposite type trade.
Well, let's talk a little bit about that PPI compared to last week's CPI. I think that's a good place to start as we look at this inflation data. I'll pull up a chart comparing the two on the video feed as well. But I know this was kind of the headline, so to speak, to start the day. And walk us through what you saw with that producer price index data that we got out on Wednesday morning.
Yeah, I think there's one of two things that turned us negative, and it really did look like mid-session more of a risk-off trade, and it could be one of the two, could be these producer and consumer price indices. The initial reaction by the trade with a 6.2% annual PPI data coming in today, supporting last week's consumer price index coming in underneath trade estimates. Today's numbers also came in underneath trade estimates, and it was a broad-based decline in many types of goods. And for instance, the receipts at food services and drinking places, the month of December, those went down about 0.9 of a percentage point. So the initial reaction was, wow, this is great news because we're not going to have to worry as much about the Federal Reserve. And keep in mind, the two big things we've been talking about on the market talk discussion between you and I has been the China COVID policy and the Federal Reserve. When does China come out of its zero COVID policy, which we've seen? When does the Federal Reserve neutralize itself because it thinks it's done the job on inflation? These numbers, this chart right here, would suggest you're on your way and the Fed can take a step back when they come into the end of the month. Maybe they raise a quarter, maybe they raise a 0.5 point, but then they come in and say, okay, we're seeing some real daylight here on the inflation front. We don't want to stall out the economy too much.
With the outside markets and the economy as well, just one other thought I have here that I think could tie in with this before we move to another thought here. The debt ceiling worries, issues I know are out there, talking about that for the end of the week. Are you concerned about any of that? And if something doesn't get done, what effect that could have on the markets here in the short term?
I did write about that in my weekly recap as we started off this week as something to keep an eye on because of the headline and whether that would cause an attraction back to a safe haven dollar buying or not. It wouldn't make fundamental sense to do that, but the trade sometimes looks at the market a lot differently than we do. I'm not nervous about it from a standpoint of the actual situation because the U.S. Treasury on Thursday will enact what they call special features, which I wish I could do this in my family budget, but they can now string out the debt to where we don't actually, the U.S. doesn't actually go into debt until all the way into mid-June. So again, that'd be a wonderful tool to use in your household budget, wouldn't it? So, but you do bring up another macro feature revolving around these inflation numbers, and that is maybe what happened by the middle part of the session was the trade started to realize, well, hold on, wait a minute. If the Fed still tightens and we're seeing this kind of a decline in retail sales and decline in inflation, what if we have a recession? So how do you balance that? You know, how do you get excited about commodity buying? How do you get excited about buying equities if you're going and drilling, essentially driving yourself into a recession? So I think that's one of the possibilities that we need to be on the lookout for as we finish out the rest of this week.
Another thing too, Mike, you and I have been talking about the relationship between SRW futures and copper and how this has been parlaying itself into the market. So let's take a snapshot of where things stand here as of Wednesday. Another chart pulled up on the video feed. What are you seeing with some of the latest data? And you look at the charts now as we look at the correlation between copper and the SRW futures.
Yeah, this is one of those charts where, simply put, I title this chart, something's got to give, historically speaking, because if we're going to go higher in copper because of China, which I think that's what we've done, and look at that, a 5-month high at the exact same time we're making a 5-month low in the US dollar. That's how integrated and closely these financial instruments trade with one another, Jesse. And so either the soft red wheat is due to go higher and match up with copper again, or the copper is giving a false flag and a false signal that it's a strong market and it's really probably going to be ready to be sold off at some time. And this is where the second possibility for today's midday sell-off and more of a risk-off trade does, I think, go back to the Chinese issue. One of the big analytical firms that the trade has really been following, I follow them too. They're from England. They took their daily possible counts of deaths up in China from 25,000 about a week or two ago per day in the month of January and early February up to 36,000. They jumped their daily death potential by 11,000 people right as we go into that 40-day spring festival, which is centered around the Lunar New Year. And so I wonder if that's not what's going on. And if it is what's going on, then again, I would suspect that the copper would start to see quite a sell-off, and you actually see these two assets come back together, unfortunately, with copper declining.
Well, and I think it's interesting as well. You know, we think about today's sentiment versus yesterday. You brought up China. We got the GDP numbers from China yesterday right away in the morning. We kind of traded some of those headlines, and then we went back to the supply-demand fundamentals of what we saw from Thursday's USDA reports. And then today, it just feels like as we got headlines in, we didn't go back to the fundamentals. So it seemed like I wonder if we've gotten past that post-USDA euphoria here at this point in these markets, Mike.
Yeah, that's a really good point to make. I don't think we have yet, but I would say that I think that the trade is wise in that it's rebalancing its long bean, short feed grain mindset because of USDA, but also because of the new fundamentals of improving South American weather, and also what China's ag ministry is finally telling us about their pork production and their hog herd. Simply put, it's just too big. And the ag ministry had a press briefing of all things and said we need to cut back on our hog inventories and production, and we're going to start buying pork for state reserves to try and lop up and suck up some of this extra pork production so that the prices can find some support. But they've been down multi-weeks in a row ever since the middle of December, and I think this is where that could feed the bullish mindset in the feed grains, but by the same token, it could feed the bearish mindset in the soybeans. And so I think that we're now, for the 2023 corn bean acreage base, Jesse, we're probably starting to trade now more of buying corn acres at the expense of soybeans. And what I think is going to happen is I think the soybeans could find some support from the wheat market, because if the wheat and the corn don't want to go down, I think the soybeans will find support off that. But if the wheat market doesn't stand up here and say, we're picking up demand, supplies are the tightest in the United States for stocks to use since 2013, we don't need any more price erosion here because we're starting to see the end users really pick it up here at the first of the year, then I think the corn bean ratio would go in favor of the corn and the beans kind of stay sideways instead of the beans falling dramatically and buying corn acres that way. It's probably the most important thing on my list of things to do as we get into the end of January, 1st of February, other than getting some more corn sales made for old crop, which I did pull some triggers today for clients.
Mike Zuzolo, Global Commodity Analytics, is our guest here today. Mike, I should have, I jumped around a little bit. My thoughts are kind of, going a couple different ways here. I should have pulled this chart up on the video feed as we were talking the copper and wheat chart, but this is a look at the spread between hard red, soft red futures, a weekly chart here. As you look more at the relationship of these wheat markets, and you mentioned wheat, corn working together or not, what do you see with this chart? Let's talk a little more about this and give us some more thoughts, what you're seeing in this wheat trade right now.
I think your placement on this chart is impeccable and perfect, Jesse, because I think this is the biggest issue I have with the soft red wheat at this point, and that is if the hard red wheat weather improves and all of a sudden we lose the hard red wheat and the funds decide to buy a soft red and sell hard red, but we really don't go anywhere. We just trade the spread. And so I really don't want to see this hard red, soft red spread give up much more than 20 or 30 cents. In other words, we don't want to go below 50 cents premium hard red against the soft red. That I think would maybe put us into kind of a tailspin in the whole wheat complex. And that opens up the downside, I think, in the new crop beans and the old crop for that matter. I think this is where we've talked about the July Nove bean spread. Now I'm introducing the hard red, soft red spread. I think what we're going to find in 2023, because it was this way a lot of times in 2022, was that the funds and the way they traded the spreads were a good leading and early indicator and kind of a canary in the coal mine of how the flat price was eventually going to go in terms of price trend. And so I'm trying to pick it up from there and try and learn some lessons from 2022.
Well, Mike, another thought I wanted to pick your brain on as well, looking at all these charts and thinking of things. I know I've heard from some folks, they don't feel the downside risk is necessarily there in old crop with how tight the situation is after USDA's numbers, but new crop, there might be some downside risk there. I just wonder if you feel the same as you're looking at all your different charts and whatnot. What is your thoughts, old versus new crop right now when we look at the grains?
Yeah, I mean, when I look at the corn, I'm not as nervous about that from a world perspective. And we are losing competitors. I think Brazil is getting close to being out of corn. It sounds like Ukraine is getting close to being out of corn as well after having a past few months of good overland shipments by rail and up the Danube River. I think the problem really is in the world soybean stocks. That, again, like we talked about, if you have an Argentine corn crop and bean crop of roughly 45 to 50 million metric tons, that's a lot bigger percentage of the South American crop in corn than it is soybeans. And so losing 3 or 4 or 5 million tons in soybeans in Argentina can easily be offset by a 1 or 2, 3 million ton increase in Brazil now that southern Brazil is getting some rains. And so that 103 plus carryover for world soybean stocks really does trouble me. And it makes me feel like that the $10.95, $11 level for new crop November soybeans could very much be in play, especially if we make our crop up here come July, August. And that's why I'm so eager to move on the beans so much more aggressively than the corn right now.
A lot of things to consider in grains. Definitely going to be keeping our eye on it as we move forward. Let's go to livestock, Mike. You mentioned hogs earlier in the show. I'm going to pull up the hog chart that you sent me, looking at lead month futures and the CME index. And this hog market's been volatile. I just, love your thoughts and insight as to what you're seeing right now with how this hog market has just been acting and what charts may be indicating moving forward.
Yeah, this is a very concerning chart because you see that the CME cash index in orange is leading the market lower, and that's because the CME cash index is picking up on an ever lower cutout price, and it just hasn't found support in the cutout market. And so that means the hog futures needs to go chasing down towards the index, especially as the February hogs gets ready to expire, because after all, they have to come together on expiration. This is the heart and soul of what we've been talking about probably for almost 6 months now, Jesse, between the pork and bean trade and being excited about China demand versus the flip side now where we've got oversupply because China's not buying, and we're going to have to deal with that oversupply in the domestic pork market. And I just got off the phone with the French news person who specifically asked about our hog herd over here in the United States. And what I said to him was, this market is telling us now we need to cut back on our breeding inventory here in the United States, because we're going to have more pork domestically to have to consume because China's not going to take it. And I think this is really important for the beef trade and the cattle trade, as I continue to talk about, as far as how can we get higher and get up to 2014, 2015 cattle levels when we have hogs at $75 instead of $135. And it really does get that simple at the end of the day.
Well, and yeah, that's a great point you bring up. That as that spread widens out, it just feels like something's got to give here in this entire protein sector right now, Mike, because you hit it there. That spread just doesn't seem like it's healthy at all for this entire sector.
No, it's not. And I think this is where it goes back to that PPI data. I'm guessing the consumer data is going to show the same thing between automobiles, interest rates, and if gas prices would happen to notch up, we will take a hit in the food side, and consumers will get going after substitutions, and that elasticity, that price elasticity of demand will start to kick in, where you got to go after substitutes to be able to feed your family, and you'll stop going to restaurants. And that goes back to that recessionary talk. And I'm not trying to paint a really black, dark picture at all. I'm just saying in the last 6 months, if we were going to take out some highs in the cattle market, and we've got this cattle on feed report coming up at the end of the week here, unless it shows a really tight supply of on feed, we really do need the poultry and the pork side to help us at these price levels.
Well, and that's a great point too, with that cattle on feed report coming up on Friday, depending on what we get, and seeing some of these numbers for you makes me think, how much is this hog market being an anchor to cattle? We keep hearing about how bullish people are in this cattle market, yet we just haven't seen that happen yet. I wonder, is this hog market just being a massive boat anchor right now?
Yeah, I think that's right. And I think if you want to flip it around and look at it from a positive standpoint, you could say maybe that the cattle market has support at the 153 to 155 level in the cash market, especially with the return of winter. I think that's a real big open mark question, and probably bringing some support into this market and keeping some new shorts off the market in the cattle, whereas they're going after the hogs. And that's where that cattle hog spread keeps getting upwards of $80 premium to fat cattle. But I think then you go back to the feeder cattle market, and that's really what the report's about for me, Jesse. We took out that 180 support level. That's a big deal to me on a monthly basis. I want to see a good cattle on feed report so I can keep those feeder cattle together, because otherwise the funds may look at it that, okay, we've got weak hogs. We've already priced that in. We're starting to see the feeders go down. Well, look how expensive these fat cattle are on the board of trade, and they kind of get away from the fundamentals and trade more of the speculative mindset. That's what I'm not wanting to get caught up in, and that's why I continue to talk about getting ready to do first quarter and second quarter fat cattle hedges, because of the profitability and that fund relationship with the cash market.
A lot of things to consider, Mike. I know we touched on plenty here today. Before I let you go, any final thoughts? Anything else you want to reiterate for us before we run out of time?
I'd be a lot more nervous about the Chinese situation than I would be the Federal Reserve at this point. If I had to pick one that I would like to see stabilize, it would be the Chinese situation, because I do think the Federal Reserve situation's improving. The bond market's starting to suggest that, Jesse. So I don't want to see the market get negative on China again, because we touched that right after the first of the year, and it was a really hard thing to have to deal with. I don't want them to have to go back to that.
Great stuff as always. And if folks want to reach out to you to get some market advice, I know they could do so online, phone call, a lot of great ways to get in touch, isn't there, Mike?
Yeah, go to globalcomresearch.com. It's globalcom with 2 M's research.com. Take a look at the product services, sign up for a free trial. I'm in the middle of doing meetings, webinars, and seminars. If you need one, get it scheduled now, because we're kind of running out of runway to get it scheduled, especially in my part of the country with the snow coming back. But call me toll free, 866-471-2588, if you want to talk about your specific operation or doing a meeting together.
Globalcomresearch.com as well. Again, that website. With that, Mike Zuzolo, Global Commodity Analytics. Always a pleasure, sir. Have a great rest of your week. We'll talk to you again next week.
You too, Jesse. Thanks always as having me.
And that's going to do it for today's show. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.